Good afternoon and welcome to this week's Elite Traders Club education session for October the 14th, 2015. The topic, as you can see, percentage volatility. I've been talking a little bit about this of recent times, and I thought it opportune to run an education session on volatility and in particular percentage volatility. So let's get underway. First of all, our disclaimer: the content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, nor particular needs. So before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances. All right, the topic for today, percentage volatility. So what we're going to do today is we're actually going to go through and, using Beyond Charts, create a very simple percentage-based volatility indicator. And the nice thing about having a percentage-based indicator is that it allows us to compare different indices, and we can use exactly the same measure. So that is a percentage-based measure. Obviously, each separate index has its own average true range, its own measure of volatility, but once we convert them to a percentage, then we can get a little bit better comparison between the two markets, and that'll help us to identify which market perhaps is more volatile than the other. And certainly having being able to compare and contrast is not such a bad thing. What we'll also do is have a look at how you can use this percentage-based volatility indicator just to provide a little bit of weight of evidence, if you like, to complement your current market risk models. So I think it's important that whilst you're understanding market risk and the indicators that we're using at the moment, which are more momentum-based, that by using a volatility-based indicator, it can actually complement very nicely and provide an overall view of market risk. So I certainly think that's well worthwhile considering and learning about, and again, being able to make some observations based on both of that. So perhaps the first thing we might do is go through and have a look at Beyond Charts. So I'm going to bring up Beyond Charts now, and as you can see, I've just got at the moment the XJO, so the ASX 200 on here. Now what I'm going to do is I'm just going to bring up a Word document, and I'll bring that over to the other side here, and this is the formula that we're going to be using for the volatility or the percentage-based volatility indicator. So it's just very simple to type this out. It's just brackets ATR, then another bracket 21, so it's looking at the average true range over the last 21 periods, then close bracket, then space, and then divided by C, which means the close. Once you've typed that in, then we've got a multiplication sign in the middle there. So space, then multiplication sign, then space 100. And so what that's going to do is that's going to convert the average true range over the last 21 days. It's going to divide it by the closing price over that particular time and convert that into a percentage. So all we need to do is just highlight that, then right click, copy. Now I'll minimize this, so that's just been copied straight into memory, if you like. Now what I'm going to do is I'm going to go up to the top here. Now I'm under the Systems tab, and I'm just going to go to Formula Editor. So when I click on that, that opens up a new Formula Editor page. And then I'm just going to right click underneath where it says new formula. I'm just going to go paste. So that's put in that new formula for me now. And all I need to do is save that. So up the top here, I'm going to click on save. Now it's going to ask me to give it a name. So I'm going to call it percentage volatility. Percentage volatility. Now it's also asking me whereabouts do I want to store this new indicator that I've created. So I've got a couple of different group names, and you'll have these as well. You can in fact create your own group heading as well if you don't already have one. So I've just created one called DMAC. So that's where I'm going to put it. You can give it a description if you like. And then I'm just going to choose OK. Now before I do that, when you've typed in your formula code, as I've done there, I've copied it and pasted it in rather. When you click on save, you should have this output down the bottom. It should say there is one unassigned output. So if it happens to say that, you'll know that you're doing the exactly the right thing. So once I've done that, I've allocated it to a group name. I'm just going to click OK. Now that's been saved for me. Now what I want to do is I also want to give this indicator some properties. Now if you just put the cursor over the little icon here next to the save icon, it says formula properties. So I'm just going to bring that up by clicking on it. And at this stage, it's going to be an indicator, which is fine. And the type is a line indicator. Now what I want to do, I've actually had a look and I think this looks better as a histogram. So I'm just going to click on the little drop down box and choose histogram. And I might even change the color of that and make it green. So I'm going to end up with a green histogram for my percentage volatility indicator. So now I'm going to choose OK. And now when I go back into my index chart here as an example, you'll see that I've got my typical market risk indicator on here that we look at every Monday morning just to see what's going on. Now what I can do on my Formula Explorer, remembering where I've hidden my indicator, remember I had it under the DMAC heading. So if I expand DMAC and go down to where I gave it a name and I called it percentage volatility. So there it is, and all I need to do is grab it and drag it onto the chart, or you can see that it's highlighted. I can also click on the apply button, that's the tick at the top there, and what it's done is it's gone through and inserted it onto my chart. So this is measuring, if you like, the percentage volatility or the change in volatility over the last 21 periods. And you can see, just looking at it, that the histogram bars are getting bigger and bigger and bigger. I think what makes this indicator even more useful is if on this indicator we apply a moving average, and what that will do is it will give us a look back period and we can compare how the current volatility is when compared to a historic look back period. So what I'm going to do is I'm just going to highlight this, and I just do that by clicking on the indicator number, and you'll see that the histogram bars have turned red. So that means that this bottom window, this bottom panel is now active. So what I want to do is I want to go up to my indicators and I just want to insert a moving average. Okay, so it's just a moving average, exponential or simple, it really doesn't matter too much. And I'm just going to put on a 63 period moving average. Now remember, my histogram bars are green, so I'm going to change the color here and I might make it red as an example. So once I've done that, if I now click apply, you'll see that in the bottom window now that I have basically a historic moving average of volatility. And you'll see that there are times when volatility extends past its average levels of volatility. Okay, and I think that's important to note, particularly with what's happening with the market risk models. So for a while in Australia, as an example, our market risk model has been coming down below 60. So again, remember we've been saying that once the market gets down to this level, the propensity for the market to move away quite quickly increases. So the rate at which it's going to deteriorate, if you like, is certainly going to have a lot to do with volatility. And as this indicator has been coming down, our market risk model indicator has been coming down, we've seen volatility start to pick up. And more recent times, particularly through August and September, it's really started to extend the rate at which the whole index is moving, not just downwards, but also upwards as well. So for a lot of these down days, you'll see that we've got equally opposite and as large in magnitude up days. So the volatility, the average true range, is really expanding. So let's go and have perhaps a bit of a look at this over a period of time. So remember, from the beginning of the year, our market really jumped out of the blocks in the beginning of January, and put on some really sizable gains. Now, those gains that we had to start with, whilst the index went up and was quite strong, you'll see that those gains were by and large at reduced volatility, so lower than average volatility. And that's when your trend following systems really work very, very well in a lower volatile environment. If we go back in time a little bit further, towards the end of last year, you might remember we had quite a number of ups and downs along the way. So still part of an overall bullish regime, if you like, a bullish biased market. But we were getting these big swings. And the reason I can say that we're still part of a bullish bias is that we've come out of these particular levels. Whilst we teetered up and down on either side of this longer term moving average, we started to move up and closed up strongly at the beginning of the year. So we were certainly in very much a neutral sort of territory, neutral, getting down into high risk areas and very high risk areas throughout that period. And as that was occurring, look what was happening to the volatility. We were starting to get big swings in the market, not just to the downward side, but upwards as well. And it's during those times when we're getting increased volatility, again, that trend following is very problematic. It's very difficult to remain in trades unless you've got a simple to follow trading plan. Let's go back in time a little bit further. During 2014, if you have a look at what's happened with price in terms of our longer term bull market, bear market indicator, our longer term moving average, price is well above it and stays above it for most part of the year. Our market risk model is certainly in low market risk or moderate market risk. But what you'll also notice is that volatility is below average. And that's a good sign. It's a very good time to be using a trend following system. And this is why it's just so important that when you're part of a trend and part of it is low in volatility, that you let your profits run. Now you've got to remember this is the overall market, and the stocks that we are looking for are going to be exhibiting higher than normal relative strength. So that is, they're going to be outperforming the broader market. Let's go back a little time, back into 2013. Even in 2013, when our benchmark is above its longer term moving average, you'll see a lot of that was during a low volatile market. Okay, so again, your trend following system is going to work very, very nicely during that time. If we go back into early 2013, around about May, you might remember Ben Bernanke was talking about quantitative easing and all those sorts of things. And at that particular time, there was a certain amount of fear in the markets, and our market risk indicators started to move down towards the higher risk levels through moderate and then into high and very high. As this was occurring, not only was our stochastic moving down, but look what was happening to the volatility. It was starting to increase as well. So again, that's where it's really important that you know what to do during those times, that you continue to manage your trades in the appropriate ways, not panic, not jump out of your trades just because you think they might be stopped out, but let them run their course. Because the chances are, during this particular time, if you've got stocks in your portfolio that have good relative strength and that have been making some money for you during this low volatile market, chances are they're probably likely to hold up. Okay, now this market did recover, and those really strong stocks are going to hold up, particularly when they've got a much wider stop. So I think that's really important to continue to remember. And look at this through 2012. The volatility compared to its longer term moving average, a nice low volatile market. So we're not getting those massive swings up and down in very short spaces. We've got a much gentler trending market towards the upside. And again, that's when your trend following systems really work very, very well. And that's when you get to lock in lots of profits along the way, just continuing to trail your stops. So what happened during the GFC? Were there any really volatile times before that? Well, again, this section through here, which you probably know pretty well, this was the Eurozone crisis. So certainly at that point in time, we were low volatile. This is sort of 2011. In fact, I think we might even be 2011. Yeah, 2011. This is a bit further. Sorry, this is GFC time, not GFC. This is a Eurozone crisis through here, through 2011. So this is really interesting as well, because what you're seeing is obviously market risk deteriorating, and that's evident by our stochastic that's moved below 60. Now remember, once we go below 60, the propensity for the market to move away to the downside increases significantly. Now as that's moving down below 60, getting into higher and higher risk, you'll start to see that our volatility has started to increase. It's now much higher than what it has been historically. And it's not really any surprise that we start to get, the market becoming more volatile and with the weakness moving to the downward side very, very quickly. So that was during the Eurozone crisis, if that's what you'd like to call it. Certainly if we go back all the way back to the GFC, and in fact, interesting that we bottomed out in the GFC around about March it was of 2009. So this is pretty much the bottom of the GFC, and you'll see that the volatility has really disappeared at the end of the GFC. So you can see there's the volatility, and that's the historic. So that's looking back 63 periods and looking back at all the carnage that was done, and the actual movements in the markets now have really flattened out. And the market starts to move back upwards, and as evidenced by our market risk indicator suggesting it's now safe to start allocating some capital back in, and we're doing that during a much lower volatile market, a much lower risk market, and the trend starts to move towards the upward side. And our market actually recovered very, very nicely from the GFC, and by and large did it with much lower levels of volatility than it had seen historically. Let's go back to the GFC. End of 2007, beginning of 2008. So we've got our market risk indicator, and we've been in low risk. Remember, this is around about December of 2007. The carnage really hadn't begun, but our market risk indicator was starting to move to the downward side. We get down towards 60. Typically through here, our volatility has been pretty much in line with historical trends. But you'll see, particularly through the likes of February, that volatility really starts to pick up, evidenced by these big downward days and big upwards days along the way. And at the same time, you'll see our market risk really deteriorating along the way. And so those of you who are familiar with the market risk levels can quite clearly see that we've got high market risk, we've got extremes in volatility. It's not the sort of place that you really want to have too much capital in the market, and our market risk levels are right down at extreme levels. So certainly a big heads up that something was going on in the markets. For a while there, the market risk did start to improve a little bit, and volatility subdued. But then you'll notice, particularly around July, coming to August, particularly sort of September time. September was a terrible month for global markets. That volatility really started to pick up. And again, we're right down in extreme territory. So when we're down at these levels and we've got high volatility, you really don't want to be having too much capital exposed to the market. By this stage, what you would have found, just through using typical trailing stop methodologies, that a lot of your positions that you're in, you would have been stopped out a long, long time ago, and you wouldn't even be participating in this downward route. So I think it's a really important concept to get a hold of. So I might just go through and have a look at the US market by comparison. So down the bottom there, I've got a blank panel. So I'm just going to get rid of that for the time being. That panel there, right click and delete. And what I'm going to do is I'm just going to insert my percentage volatility. There it is there. And we'll do exactly the same thing. We'll put on the moving average. There's my moving average with the red on it. And there we go. So again, you'll see quite clearly that of recent times, volatility has really risen very, very dramatically. And it occurred at around about the same time that we fell out of this sideways type of market. And I think that's really important to understand. Since then, volatility is still very, very high, and we're still down in very high market risk territory as well. So we certainly need to be very much in capital protection mode. Certainly throughout a lot of 2015, we've been in a fairly low volatile market until we sort of got up to around about July, August, when things started to become a little bit more volatile, a little bit more up and down, and that's evidenced through these bigger bodied candles through the latter part of this year. Just having a look at the volatility there, you'll see periods where, as we get into moderate and higher risk, that we're starting to get increasing volatility. Now remember also that low volatility, it's not going to go on forever, and that from time to time you're going to get blow-offs in volatility, if you like, either to the upward side or to the downward side. In between that, when we're in a low volatile market, through here as an example in 2014, the US market really just moved up very, very nicely. And again, a great opportunity to be in a trend following system and banking profits along the way through using a very simple to use trailing stop methodology. Now certainly there are periods where, again, we go through nice and low volatility, on a longer term perspective, much lower than usual, and the index just keeps moving along really, really nicely. And those of you who are trading the US during this time would have seen some fantastic gains along the way. And probably, if you'd used good trailing stop methodology, banking some really, really significant winners during that time. And every now and then, a little bit of volatility coming through and perhaps challenging your ability to follow your trading plan. But in all likelihood, if you've got stocks that are showing good relative strength, that they will be certainly holding up fairly well for you. Now again, you're never too sure which stocks that you've got are going to be those that end up being the ones that deliver you lots of profit. You've just got to create the environment to allow it to occur, and that means just trailing your stops accordingly. Again, for nearly 6 to 7 months where we've got a really nice low volatile market, and you'll see the market just continuing to chug along, small bodied candles just moving nicely in an upwards direction. So again, using the volatility in accompanying with your market risk really should give you the confidence to allow you to follow your rules. I mean, at the end of the day, the only thing stopping you from following your rules is yourself, and perhaps having a little bit more knowledge about the markets and market behaviour, so that you don't try and second guess what's going to happen into the market, that you actually become a little bit more disciplined in the way that you manage your portfolio. So again, nice periods of low volatility and the market moving up at exactly the same time. So hopefully that's given you a little bit of an insight into market volatility, and particularly a percentage-based model. It does make it very easy to use. The other thing that you can do just before we finish up, at the moment you'll see that in the currently in these two markets, volatility in the US is at 1.53. Okay, 1.53. So let's see which market is more volatile at the moment, the ASX or the S&P 1500. So that's at 1.53. And I'll have to go back and put on my indicator again. So let me just do that. That's empty. I'll just clear that panel out of the way. Delete him out. So 1.53 in the US, and at the moment the ASX, the volatility is 1.71. So our market is more volatile of late than what the US's is. Okay, 1.71 compared to 1.53. I wonder whether you guessed that or not. But certainly, having a look at the candles, etc., big up and down days right throughout, it's certainly no surprise. But again, nice to be able to compare the two. And if somebody asked you which market is more volatile at the moment, you could certainly put on this indicator through creating it very simply, and you'd be able to answer that question. So that pretty much wraps it up for this particular week on the education side of things. Hopefully that's been of some use for you, particularly I think through the weight of evidence and certainly accompanying market risk gives you a much better feel for what's happening with the market, and you can make your own observations there about what's happening in the market at any given time and what you should be doing in terms of managing your trades. That's it for this week. Thanks for watching, and we'll catch up with you at next week's education session. Bye for now.